Welcome back, dividend growth and value investors. In today's video, I will share with you my latest portfolio transactions from the month of July, my perspective on Clorox dividend hike, and a look into the latest earnings from Castellum. If you're new to this channel, welcome. I am European dividend growth investor. This is a channel dedicated to dividend growth investing with the ultimate goal to retire early. If this intrigues you, then feel free to subscribe, ask questions, and follow me along the journey. Because I'm not sure about you, but I'm bad at sporting alone. I much more prefer team sports as it gives me that extra motivation to go out and to go for training, even if the weather is just horrible. I treat this community the same. Simply said, together we are stronger. But hey, enough about that, let's get started. So look, from annual dividend income, I'm almost already at the same level as last year. But what's even nicer, it's now mid-July and I already passed my dividend income from last year. Of course, this is one of my lowest income months, but actually October is even lower, or November. So although I've got the most behind me already, I do expect this graph to maybe grow a 30-40% year over year. So if I then look at what I have earned so much this month, and this is really what I love about dividend investing, I received on the 1st of July dividends from Pepsi, Digital Reality Trust, which is a really small position for me. I bought some Texas Instruments. I just had to really make use of the opportunity. I bought some at 147.47 cents. I got a big dividend from Red Electrica, a utility company from Spain providing electricity to all citizens. Then I got my dividend from Castellum. It was one of my first big dividends. I really loved this one. I got still a dividend from Kimberly-Clark. I didn't sell Kimberly-Clark yet, but it's still on my list to do so. Then I got my dividend from HP Inc., a company which I find highly undervalued even at the price still today. I also got a nice dividend from Enagas. I know many Spanish people don't trust Enagas and neither Red Electrica. I'm fine with it. I understand the risks, the political risk. For now, I find the dividend safe, not very safe. There's definitely risk associated if further regulation kicks in. But I'll take the 8% dividend anytime. It's been doing me well over the last 4 or 5 years. Last but not least, I got a handsome dividend from Chubb as well. I bought Chubb, I think in May 2020 or June 2020 at $100 when I sold my Disney shares, also for around $100. Disney, as you know, is now still trading, I believe, somewhere at $100. Chubb is probably somewhere around $180 or $200. You know, this is such a sleep well at night stock that I even don't look at, not even on a monthly basis. Last but not least, I bought some Allianz this week. Allianz for me at 177 euro. It dropped even further after that. For me, anytime when it's below 200 euro, I found it already attractive. It's currently yielding 6+%, and I'm slowly building up my position in the company. If we look at that, it's now my 21st position, number 21, at approximately 1.9% portfolio size. Okay, so these were some of my portfolio updates from the first 2 weeks of July. You told me several times that you would love to see more of these updates to keep a bit track on how I'm doing, how the dividends are coming in, and what portfolio movements I'm making. Now, having said that, there's one company that always intrigues me, and this company is Clorox. Clorox announced this week a dividend hike, a quarterly dividend hike from 1.16 to 1.18 per share. This is an increase of 1.76%. Now, for many people, this is really disappointing. But to be honest, I'm very bearish on this stock, and I fully understand why this company is doing just a token hike, because the company effectively doesn't have any free cash flow to spare. It's actually leveraging up at the moment to pay out its dividend. The simple reason for that is many people thought that Clorox was the ultimate pandemic company, and that's true. Many people needed their cleaning materials and their cash flow blew up into the sky. But you know, that's just it. That's really just it. All these earnings have evaporated already. We're not coming back there. And you can see that here because, for instance, the cash flow 1.2, almost 1.3 billion back in 2020. Now it's 580 million trailing 12 months. I mean, if you model with 580 million, this company is really not worth a lot and it's currently still trading $148. I truly believe that this is mainly because of the dividend. The new dividend yield after the hike is 3.17% and it has now been growing 45 years its dividend. And honestly, I think this shows how much the company is committed to the dividend. Because if you look at it, the 5-year dividend growth rate is 8.9%. That's definitely not the same as the 1.7%, but it has no space to grow. The dividend is not covered by the EPS. The dividend is hardly covered by the free cash flow. And if we then look at it at a price to earnings and forward PE even, it's 37 and the price to free cash flow at 32. It's just too little. The company has so far not been able to pass on the costs of the inflation to the consumer. We will soon hear if this will change when the earnings report comes out. I truly hope so, that they are finally able to pass something on, because they need more free cash flow. Hence, if I model with 750 million in free cash flow, 6% growth rate first and 4% thereafter, and a 10% discount rate, so that's the return I want to see, at a multiple of 14, it's currently at a multiple of 39, way overvalued. I believe a consumer staple like this should be trading around 15, specifically if it is under stress because of the cash flow. Then we're just talking about a fair value of $97 or something like that. I mean, come on, it's not even close to that. It's $150 right now. For me, it's heavily overvalued. I'm staying away. I don't expect any dividend growth really going forward. Next year, if it continues like that, will be again 1%, 2%. They need to find back a path to growth. I'm not seeing it at the moment with this company. I hope I'm proving wrong. But this is also the reason why I'm currently not investing in Clorox, although the dividend yield is easily passing my screener, the 5-year dividend growth is passing my screener, the Chowder rule, but these all have backwards looking historical figures in there. If we start looking forward, it just looks ugly. Hence, I'm not buying it. I would love to say something different, because as a business and as a portfolio, these are awesome, top-notch products, but as a stock, not for me. So this was my quick take on Clorox. Now let's also look into Castellum. Castellum reported their earnings this week, and I think it's really important to look at this. Because look, the share price really crashed in the last, let's say, 2-3 months, specifically since the start of this year. And it did it one time before in the pandemic, because everyone was thinking like, okay, the office space is dead. Now there's really a fear around the impact of inflation to the company. So there are 3 questions that I would really love to ask when we are looking now and analyzing the earnings of Castellum. So how is their operating cash flow compared to last year? So real estate investment trust in America typically report funds from operations. Castellum reports an equivalent to that. The second question would be, how is their net asset value developing? Although it's not a metric that I look too closely at, because this is highly influenced by any CEO and what the bookkeeper thinks about it. Still, it does matter when we look at the confidence of, for instance, the credit companies, the banks, and how they look at it. And then thirdly, is the debt going to be an issue? I think that's one of the main questions in my mind. Can they easily consume, for instance, increasing interest rates, or will this become a problem to the cash flow and therefore the dividend safety of Castellum? Now, if you look at my track record, I have been buying Castellum several times. I bought the 21st of February at 201 Swedish crowns. Then I bought some again on the 22nd of April at 199. Then on the 9th of June at 172 when the stock price was really crashing. And then 1 week later, again at 137. So there was quite a significant drop. It's currently trading at around 146, so it bounced back a little bit. So that leaves me here with a paper loss of 30%. And of course, I don't care so much about the paper loss. It's all about the dividend safety and my dividend growth going forward. So my question is actually, should I buy more? So if we then look into the earnings back, what is good to mention here, that generally the vacancy rates are relatively stable. It says here slightly down, but this is for me really not anything to worry from what I've been looking into. What is therefore for me way more important is, how has their operational cash flow been developing over the first half year compared to last half year? So if we look into that, right, and how does the company measure it? It uses income from property management. Let me increase it also a little bit for you so that you can probably read it a little bit better. So income from property management has been calculated by taking the income, what we also usually use for instance, deriving the earnings per share, but we take the non-cash events out of it. Because, for instance, the fact that values are becoming more worth and that this goes to the bottom line according to the accounting rules into the books, into the income numbers, is not having any cash impact. And it doesn't matter from that point of view for something that we want to see. Because if you are renting real estate to your tenants, you are mainly concerned from the operational cash flow that you are receiving by the payments of your tenants. So we deduct this number from the income. Then also we look at the change in value of derivatives. I mean, this is more like financial hedging, speculation and such, what a company needs to do to, for instance, make sure that their debt is hedged. And if we deduct that as well, we are having an income from property management around 1.2 billion. This is over the last 3 months. If we look at over the first half year, it's 2.3 billion, 2.4 billion. Last year, this was around 1.6 billion. Of course, we had an acquisition in between here. So that's why also the cash flow was expected to go 30% up. But it's also good to see that it's actually doing that. So last but not least, if we then look at the 12 trailing months, we're looking at a 4.2 billion income from property management, and which is approximately 13.6 per share. Remember, the company is currently trading at 146. So we're talking here about an 11 price to funds from operations, let's say. So for me, this means that the company is really attractively valued. And what is also good to see is that we are seeing a general increase in operating income. I'm really happy to see this, and it makes me already sleep well a little bit more. So if we then look at the net asset value, so I mentioned to you, this has a little bit of impact here, right? But it's hard to compare because of the balance sheet compared to last year. But we can see what it has been doing since the 31st of December. And what we can see here is that there is a small increase compared to 31 December last year. So I'm really happy seeing this because it means that so far, if we look at the valuation at least, the current market dynamics and the really rapidly increase in inflation and the increase in interest rates has not yet led to lower valuation of their properties, and they would need to revalue if the market would be crashing. And therefore we can also see that it has been growing on a per share basis. So then the last question is like, how is it looking from a debt point of view? Can they easily meet their debt obligations, and how are they looking from a refinancing point of view? So for that, we go a little bit up back into the earnings report, and effectively it's telling us here. So from a maturity point of view, if we look at it, it has an average interest rate for what needs to mature in the first year. This is 35 billion, approximately 48% at an average interest rate of 2.5%. So this will need to be refinanced, but so far they have been doing this well. Because if we look at it, they were issuing bonds in the beginning of the year with a credit margin of 1.9%. and a tenure of 5 years. So this is already showing that they have a good capability to still get interesting interest rates. Also, the interest coverage ratio during the last half year was a multiple 4.7. So it decreased slightly from the 5.2, but still way above the norm as where I would like to see it. And then also, if we look at the average remaining interest rate and debt maturity totaled currently 2.9 years compared to 3.3 years before. So here again, it is worsening a little bit, but really not something to lie awake from. If you look at what the share price was doing with a drop of 35%, this was more like a doomsday drop, right? I'm not seeing it in the numbers. So if we then look at their financial policy, and I really like this overview because it's really shareholder friendly, right? So what's important to look at policy is what the company sets as a policy themselves, and then the commitments are towards the bank. So everything is even still below the policy numbers. Also the interest coverage ratio, we saw 4.7, policies 2, commitments 1.5. So they're far from getting in trouble with any commitments towards their credit facilities like the banks. The same here of secured borrowing assets, 13%. So the average debt maturity, 2 years in the policy, 3.6, almost twice as much. So this company is just really conservatively managed, which means that after looking into their earnings, I feel really comfortable still with Castellum. I think the drop that we have seen is not warranted. A price to the equivalent of funds from operations of 11 of 12 is really cheap. So if we go back then to my dashboard and we look at Castellum here, look, almost everything is on green. A relatively good credit rating, but 24 years of dividend growth. The dividend yield currently of 5.19%. Strong dividend growth, 5 years of 12%. So imagine that it would continue to grow with 10%. What is kind of their goal as well long term for this company. We're talking at, let's say, a 10% yield on cost within 7 years. Not sure if it's able to do that, right? I don't know how the market will develop. And there are some risk related to the office space here. But for me, at the current price of 146 Swedish crowns compared to a fair value around 186 to 200, that's usually what I calculate here. For me, this company is just heavily undervalued. And therefore, if it drops again to, let's say, 130, 125, I will just buy an additional set of shares again. I'm not done yet with this company. I find it really attractively valued. The recently released numbers have really lowered my stress level around this company, because initially when I saw the share price, I felt like, oh, what the heck? But now I'm fine. I know what I own. I've been tested with this, and I believe I could definitely buy some more if there's another opportunity in, let's say, the low 120s. Hey guys, this was it from my side. I hope you enjoyed this video today. Keep on investing, guys. Keep on dollar cost averaging. We'll get there. Focus on the cash flow, not on the share price. As you see, I'm sometimes also weak of heart. But guys, hold on there. We'll get through this. Have a great weekend.